Signature Indexed Universal Life product. This is just our little disclaimer page. And now what we're going to talk about today is the new Signature Indexed Universal Life product, how it works, how differentiated between the old IUL product from Anico and our new generation product, give some examples, some uses, and then we'll conclude. Now, financial security isn't simply about growing a nest egg, saving for retirement. All of that's part of financial security, but it's also about protecting the people you love, providing for the people who depend on you, looking for other ways to help your financial situation, perhaps through supplemental retirement plans via accumulation value and policy loans. It also provides the ability to have tax-deferred buildup. So there's a lot of uses for an indexed universal life policy that we never had available in the past when insurance just seemed to be purchased for the death benefit itself. But not one size fits everybody, so we have several more solutions than we had in the past, so each individual can really tailor-make the product to fit their financial needs, their financial risk temperament, and the like. With Signature Indexed UL, we're going to provide with that product estate protection. Not everybody has to worry about estate taxes, but still protecting your estate, things like long-term care and all of those things that can go into depleting an estate. And so then rebuilding that at your death for your loved ones is a very positive thing to provide them. It also is going to ensure retirement income for a surviving spouse. So if something happens to the insured, now the surviving spouse's retirement is really taken care of. It provides support for an aging parent. And you can also leave an inheritance to children or grandchildren, borrow out money to provide for their education. So there's a lot of things that this is going to do for the family. Signature IUL, what's the difference between Signature IUL and the Anico IUL that we've had for the last several years? Well, we've moved to age nearest versus age last. And in most cases, that's going to result in reduced mortality charges. The cash value accumulation test has been added. It's for minimum pace amounts of $100,000 for the cash value accumulation test. But if you choose that, it's great if there's going to be any dump-ins, roll-ins of any lump sums at all, just to be able to build your cash value more rapidly. In most cases, increased target commissionable premium is going to be found in the new product versus the old product, and yet the commission percentage is going to be the same. No cuts in commissions whatsoever. That'll be the same as it was for the old product. We'll now have partial ABRs to go with the full ABRs that we've had for several years now. And again, we've increased the maximum amount. The maximum amount is now $2 million for issue ages up to 65 and $1 million for issue ages 66 or greater. And the other nice thing about that is you won't have to, if you want $5 million, you won't have to have 1 for 2 and 1 for 3 to total the $5 million. You could have a $5 million policy, and $2 million of that $5 million would be available for acceleration if the individual was 65 or under when they purchased the policy. 2 new index strategies, so we're going to be offering really more choices, yet within the same S&P 500 index, because we don't want to make this too complex with multiple indexes, one index but multiple choices. So we try to keep it as simple as we can and yet offer your clients more choices with which to spread their premium dollars around. Now the illustration. I think you're going to see in the illustration an opportunity for higher early accumulation value for dump-ins with the cash value accumulation test. And also, in most cases, what we've tried to do is create greater cash accumulation at retirement. So I think you're going to see when you run the new product for clients, they're going to see the ability to take out more projected income under the illustration than they had in the past, because the cash value accumulation is going to be greater at retirement ages. So I think that's a huge plus that you're going to find when you look at this new product. Face bands, amount bands have changed a little bit, 25 to 100, 100 to 250, 250 to 5, 5 to a million, and a million. So those have changed just a little bit with this product. Death benefit options. We've got option A, B, and C. Now A is death benefit equals the greater of the specified amount as shown on the policy form, or the minimum death benefit calculated under the standard guideline premium test or the cash value accumulation test, whichever is chosen. Now each of them will have that option available, but in option B, we go from the specified amount to the specified amount plus the accumulation value. And in option C, we go to the specified amount plus all premiums paid, including riders, less any partial surrenders that are made. So there are three different options there. Now let's talk about changing between options and what you can and can't do. You can change from A to B at any time prior to the anniversary of the issue date following the insured's attained age of 85. Now, moving from death option B to death option A can be requested anytime after the issue date. Now, no one can move from A and B to C. That's just not permitted. And moving from option C, you're not permitted to move to option B, but for option A, you can request at any time after the issue date to move from option C to option A. So that kind of gives you an idea of death benefit change restrictions that we have. Now, the Index Universal Life provides an opportunity for accumulation, but it is not a securities investment. No money is actually invested in a security or a stock market or an index. Movement from one period to the next on the index is tracked, and interest earnings are credited based upon the performance of the index. So the Index Universal Life is not a registered security or stock. It never invests in a stock market or an index, but what we do is we track the movement of the index and mirror that in the interest we credit to the account based upon whichever indexing strategies you choose. Now, indexing. An index is a financial measurement of changes in the market over a long period of time. American National uses the S&P 500 index to determine interest earnings in index strategies for IUL. It's more representative than any other index. It's just a very good index to use. Now, when we're tracking the changes, you're not going to see tracked any dividends. You're only going to see tracked the changes in the market value of the S&P 500 underlying stocks. Now, the S&P 500 is a list of 500 U.S. companies and a stock market index owned and maintained by S&P. It's often used as a baseline for comparison in stock and mutual funds performance charts. It can be more accurate as a predictor of U.S. markets than the Dow Jones, and so we felt this was the best index we could choose, and then off that index goes all of our indexing strategies. And here's the little disclaimer our compliance folks would like you to read, that this is an S&P Dow Jones index, has been licensed by American National for using that, and you can read the rest of it there. Okay, policy features, premium payments. Of course, premiums paid for death benefits are the same premiums that contribute to cash value. So we take out the cost of insurance that year, and then the rest goes into the cash value. And you can allocate premiums then that make up this cash value to index strategies, or also to a fixed account that we have, or you can do a combination, which is what we would expect most people to do. There is a surrender charge, so if you choose to cancel your policy in the first 10 years, surrender charges probably will apply. Cumulative interest rate guarantee. At full surrender or the insured's death, the accumulation value will not be less than if all net premiums had been allocated to the fixed account with a 2.5% interest credited throughout the life of the contract. So if you get past that 10 years and you surrender, you're guaranteed that 2.5% minimum return, even if you did not get that high of a return on your indexing strategies. Now, depending on the chosen allocation, the policy earns any combination of, first, a fixed interest rate periodically declared by American National for the fixed account. So you've got the fixed account. We don't change the interest rate often, but as interest rates do move, it can move upwards or downwards. And then the index interest rate, an interest rate based on the change in the value of the S&P 500. So again, we're not saying you're going to get the growth in the stock. You're getting an interest rate based on that change in an index strategy. And Signature IUL has 3 different index strategies. We've got the old one, the point-to-point with a cap, the 14% cap, and point-to-point with 1-year point-to-point, of course. Then we've got the 1-year point-to-point with a cap and a higher floor. So on that one, you may have a minimum return of, let's say, just for illustration purposes, 1.5%. So if the market does 0 or negative, you would still get the 1.5% return there. So but of course you're going to have a cap on that. So to get that higher return, there's going to be a lower cap there. Then you've got the point-to-point with a specified rate. And that just says, okay, if the market either is totally flat and doesn't go down, but doesn't go up, or it goes up, you're going to get that specified rate. So if, let's say, that rate is 7.5%, just for illustration purposes, if the market does 0, the market does 2%, 3%, 4% that year, that S&P 500 index that we're measuring, you're going to get that 7.5 or whatever that's set at if the market even goes up 1 cent from the prior year. So point-to-point with a specified rate is a great strategy if the market's kind of going sideways and not in an upward trend. Now, at the time the policy is issued, multiple accounts or strategies are established. And the first one is a sweep account. And that's where we take the minimum estimated monthly deductions for a period of 12 months. And that sweep account has to have that amount in there at the start of the year. And so we can meet those monthly charges. So all net premiums are deposited there. And then after that amount that's needed for that first 12 months is allocated, then all the rest of the money is going to be allocated as the client chooses the fixed account or the index strategies. And we're going to have a supplemental page that's in addition to what we had in the past for that, supplemental application page where you and the client are going to actually list what percentage do you want in the fixed account, what percentage do you want in perhaps index strategy 1 or 2 or 3. So that's what that'll be done at the application so that when it's approved, when it's funded, then you're going to be able to already have the strategies in place. Now, the fixed account is going to earn interest at a rate periodically determined by the company, and that can change during the course of a year, but it's not going to change very often. But if we see a steep increase in interest rates, a steep decrease in interest rates, that would cause it to change. Now, indexed interest crediting strategies, we have several strategies, and they all use the annual reset point-to-point. So they're 1-year strategies, and they measure the performance of the index, in this case, of course, the S&P 500, between that 1-year period, so the start date and then the end date 1 year later, and we determine the interest rate to be credited to a matured index segment in one of those index strategies based upon what the market does in that 1-year period. Now, the interest credited is subject to other limitations such as cap. Of course, all of our strategies, you're 100% participation there. Now, the fixed account is going to earn interest at a rate determined by the company, interest calculated on a compound method assuming a 365-day year. Interest is credited at an annual effective interest rate. Any surrenders are going to reduce the amount of interest credited to your policy. There's no minimum associated with the fixed account. The sweep account transfer may allocate any percentage you choose to the fixed account. However, the combined total percentage is allocated to the fixed accounts, and the index strategies can't exceed, of course, 100%. So when you're filling that out, make sure it comes up to a 100%. So we're properly allocating from day one. Now, each transfer from the sweep account to an index strategy starts this one-year measuring period called the index segment. Interest on each segment is calculated at the end of that 1 year. So what happens in between? It could go up, down, and do both. It's what is it on the first day, what is it on the last day. And no interest is credited in an index strategy segment until that year is up, until that 1-year maturity date, or upon the death of the insured if that occurs prior to the maturity date. Now, any amount deducted from a segment prior to its 1-year maturity is going to earn no interest except in the case of the death of the insured. So if you're pulling out your 10% free amount, remember, for that year, you're not going to get any interest on that amount that you're pulling out. Now, let's talk about participation rates. That's the percentage of the total increase on any segment used in calculating the amount of indexed interest to be credited for a segment. Now, American National, all of our participation rates for each of our 3 strategies is 100%. So at this point, you don't have to worry about anything about participation rates going down. We reflect the market conditions typically with our cap rates. Declared for each index strategy segment when it's created, doesn't change during that segment, it's locked in for that segment. The cap can be different for each index segment created, though, but the cap will never go below the guaranteed minimum cap percentage of 3%. So the cap will always be at least 3%. Now, what determines what that cap's going to be? Well, bond portfolio returns, short-term interest rates, volatility of the stock market, that's a big one. You know, if you have a steep yield curve, that's good for caps. But currently we have a flat yield curve, which is bad for caps. Stock market volatility, if it's low, that's good for caps, which right now it is low. Stock market volatility, if that becomes high, then that's bad for caps. So that's kind of how the caps are determined based upon current market conditions prior to entering into a new segment. Now, point to point with a specified rate. At the maturity of each indexed strategy segment, the 1-year point-to-point period, the change in the index is measured. So if there was an increase or no change, the specified rate is multiplied by the value in the index segment to calculate the interest credited. So if there was a decrease in the interest in the index, no interest would be credited. So the nice thing is if the index goes down, or you're not going to lose anything, you're just going to get a 0 return for that year. If the index stays the same or goes up, then you're going to get the specified rate. So it may go up 1%, and if the specified rate is, let's say, 7.5%, you're going to be credited with 7.5%. So in a market that's kind of going sideways and the like, specified rate looks pretty good. And again, with all these, please keep in mind that not one strategy is going to perform well in every market. How the market performs is really going to dictate how that strategy does. And as we know, markets change over time. Point to point with a cap. Now, this is our typical one that we had with the Anaco IUL, 14% cap. At the maturity of each index segment, the participation rate, which is 100%, multiplied by the percentage change in the index value. And then the result would be subject to the 14% cap. But again, it can never be less than the declared floor, even if the S&P went down. So with the declared floor of 0, then we don't have to worry. We're not going to lose money on the whatever the S&P does in that particular segment. But if it goes up, we're going to get and participate 100% in the growth of that market up to the cap of 14%. Now, the final interest rate will be multiplied by the value in the index segment to calculate the interest to be credited. And that change in the index and the cap and, of course, participation rates are all part of determining what interest will be credited. Now, if the index moves up, there's an opportunity to have a larger amount of interest credited to the segment subject to the participation rate and the cap in effect. But if the index moves down, the index credited could be 0, but never below 0. Now, to calculate the change in an index directly from one point to another point, compare the value of the index on the first date, the date you enter that segment, and then compare that to the second date, date B, which is the day the index closed on that segment. And so in this case, we started out, just for illustrating purposes, with a index of 1,000. At the end of that one-year term, the index closed at 1,100. When we look at the difference from the start of the segment date A to the end of the segment date B, we see that we've gone up 10%. When we do the calculation, it shows we've had a 10% increase. Therefore, the index from date A to date B increased by 10%. Now, on this hypothetical, we're looking at, let's say, with a $10,000 value at the start of the segment. We put $10,000 into that segment at the start. It went up 10% at the end of that segment, but we had a cap here of 8%. So it went up 10% or $1,000 on that, but our cap was 8%, so we credit the 8% or $800 to that segment gain on that money. Now, in the prior example, even though the change in the index value was 10%, the cap was 8%. So the maximum interest that we could be credited with that matured index segment was going to be 8%. Now, if the sweep account value is below the minimum, any deficiency, let's say at the end of that year, now our sweep account value is below the minimum, we'll then have to take some of that, the maturing index strategies, and take value from that to replace the sweep account to make sure that there's 12 months of charges in that sweep account, and then we reallocated the remaining assets to the new segments that are then created. Okay, point-to-point strategy. The point-to-point strategy, participation rate is going to be 100%. It's got a 0% floor. At the end of the segment term, if there's a decrease in the value of the index, it's going to be 0% return. If there's an increase in the value of the index, it's going to be credited the percentage of the index up to the cap set at the beginning of that segment. So going into it, your client's going to know what's the max they can earn. They already know that the minimum is 0. They're not going to lose money on it, so it enables them to be able to really lower their risk and transfer some of that risk to the carrier, to American National. Now let's look at this hypothetical example. Our cap rate's 14%. The index increased 16%. So if the increased 16%, we can then allocate 14% of that 16, or 14 of the 16% to the segment in that case. So you'd lose out on the last 2% because your cap is 14%, but in that case you've got a 14% return. Now, what happens if the index decreases 4% during that segment? Well, we've got the floor of 0%, so what we're going to credit to that strategy is not the negative 4%, but the 0% floor. So in that year, the strategy earns no funds, and the segment amount remains the same at the end, and there's nothing credited to it, but there's also nothing taken away from it there. Point-to-point strategy with a cap and a higher floor. This is a new one we have. It's, again, participation rate's 100%. The strategy has a declared floor of, and again, for illustration purposes, we're just saying 1.5%. Don't know if that's what it'll come out with, but it's higher than 0%. So at the end of the segment term, if there's a decrease in the value of the index, this segment and this strategy is going to be credited at the rate of the declared floor. So if that's 1.5%, the market can go down, but your client is still credited with 1.5% if that's the amount of the floor. Now, if there's an increase in the value of the index, the strategy will be credited the percentage of the increase of the index up to the cap at the beginning of the segment term. So, and you're going to have a lower cap because we're guaranteeing you a 1.5% return even in a down market. There's going to be a lower cap because we're going to have to go out and buy hedges against that so that we can pay that 1.5% even if the market goes down. So, no, even if the market went down 4%, you wouldn't have a 0% floor. You'd have that 1.5% floor, and you'd be credited with 1.5%. So in a down market, the higher floor really starts looking good. Now, point to point with a specified rate. You know, an interest rate is set at the beginning of the segment term, so your client knows if I go into this, this is going to be the interest I get if the market stays the same or goes up. And if the value of that index increases or remains the same, that individual is going to be credited with that specified rate. If the value of the index decreases, the strategy is going to receive no interest earnings because of the 0% floor. So you're never going to lose money, but even if the market only goes up slightly, you're going to get the specified rate. Again, very good in that kind of market going sideways. Now, hypothetical example, assume the specified rate is set at 7% for this segment. Now, if we go up 10%, the interest credited is going to be 7%. So we might go up above the specified rate, but you're still going to be receiving the specified rate. Now let's say the market stays the same and is exactly the same 1 year later than it was at the segment start date. No change in the index, you're going to get the 7% return. Now if the index goes down, let's say we started at 1,300 and it goes down to 1,170, we've had a decrease, but again, with this segment, you're going to receive no negative return, so you would be credited on that segment with a 0% return there. Loan options. Signature IUL offers two policy loan options, a fixed loan option and a variable loan option, and they're somewhat different. So let's first talk about the fixed loan option. It has a fixed loan interest rate of 6% in arrears. Now with a fixed loan option, the accumulation value in the policy equal to the policy loan is going to be transferred to a loan collateral account, which is created when the loan is taken out and is in addition to the sweep and fixed account and the various index strategies. So you've kind of created a new strategy here, which is the loan value, and that loan collateral account is created, and then you're paying yourself 6% interest, and that 6% interest is going into that loan option account there. So transfers will be taken from the parts of the accumulated value in the same order as the monthly deductions. All funds transferred to the loan collateral account will be credited with this 6% interest while held in the loan collateral account. So really we had our sweep account, our fixed account, and our index strategies. Now we've added a loan collateral account with a 6% fixed return that your client is going to be paying into the policy, into this loan collateral account. Now with the variable loan option, we don't create a collateral account. And the interest rate in effect can change from year to year. So it's adjustable on a policy year basis up to the maximum allowed by law. So if we get into a very high interest rate increase, that's going to definitely be reflected with the variable loan option. Any outstanding or new loans taken during the policy year would be charged that rate during the year. At the end of the policy year, a new variable loan interest rate would be in effect for the following policy year. So it's fixed for the policy year, but then each year it is subject to change, and if you've got rapidly increasing interest rates, that can change significantly. And unlike the fixed account with the collateral account, there's no collateral account created with the variable loan option. Your accumulation value remains allocated to the sweep, fixed accounts, and index strategies and continues to earn interest as if no loan had been taken. So there we're not creating in the variable loan a collateral account. We're simply paying the interest in and then seeing what the various accounts would do on their own. Now the loan option term, you're able to change that loan option annually with a maximum of 5 loan changes over the life of the policy. So let's say I start out in the variable loan option and interest rates start shooting up very rapidly. Well then at the end of that policy year I'm probably going to want to change to the fixed loan option, which has probably gone up itself since interest rates have gone up. So that's what I give up. Well, I've got 6% fixed. But that could go up too. Interest will be charged based upon the loan option in effect, the death benefit reduced by the amount of the loan and the interest. So if someone dies with an outstanding loan, their death benefit is going to be reduced by not only the amount of the loan, but any interest that remains unpaid. Policy loans are subject to interest charges and can reduce the death benefit paid to beneficiaries. While loans need not be repaid, outstanding loans may affect the policy's death benefit, the value of the policy, and possibly the length of time the policy remains in force. When we're recommending to our clients that they take supplemental income, we've got to be very careful as to how much we recommend they take so that the policy can continue during their lifetime. Because if the policy if they take too much money out, if they don't listen and say, well, I need a little extra, I'm going to take a little extra each year, and they do that, the policy can terminate due to lack of cash value to pay the premiums, ongoing premiums. That policy can terminate and your client's going to get a huge tax bill. So we need to be very careful that our clients don't over-distribute using the loan option, or they could crater their policy, not have a death benefit left, and also have a huge tax bill. Now, who's a candidate for signature IUL? A person who doesn't want to lose money and is willing to give up some potential interest earnings for the possibility of greater interest earnings. In other words, if somebody's in a CD, we're going to still provide them safety of principal, but they're going to, with the signature IUL, have a greater upside. So we're looking for people who perhaps lost money in 2008, do not want to repeat that, but want the ability for higher returns. Somebody who doesn't sleep well with economic uncertainty. Somebody who seeks greater interest earnings that you can get with the signature index universal life than what you might receive with your typical UL policy. Someone who's looking for guarantees backed by the claims-paying ability of American National. Someone who does not want to directly participate in the market because of fear of loss. And so that makes this look much better if you've got a client who's been burned in the market and says, I just want to do anything I can to avoid being burned again. Now, the advantages are we're going to give them flexible premium payments, low-cost permanent life insurance, so they're going to have the protection to protect their family, tax-deferred growth of accumulated cash value with the ability to borrow against that growth, and generally a tax-free death benefit if all things are properly followed. The money should be received tax-free on the death benefit. Now, Index Universal Life meets the needs of multiple markets and multiple buying groups. For that high net worth client, they've been in the market, they understand the market, they understand interest crediting based upon the performance of an index, and they like the fact that interest will never, credited will never be less than zero. They'll never lose money, at least from the segment strategy. They'll never lose money from that. And for the younger customer in their 30s, this is a product they can get their hands around. They can understand. You may have one spouse that's conservative, one spouse that wants to make money, and this is a great product that meets both of their needs. So it's a terrific one for younger people who have a number of years to retire and can grow that cash value significantly. Now, for the guy in his 50s who needs $100,000 to $250,000 of coverage and may need the incentive of having that supplemental source of money for retirement, maybe having money for future grandchildren's education, and by having these, we can satisfy multiple needs for that client. We can provide the client who's the insured and the premium payer benefits during their life as well as the benefit that takes place upon their death. So for anyone looking for permanent coverage who can see the benefits of potential higher accumulation value, Indexed Universal Life can be an answer for them. You know, Wall Street would say, well, we'll grow your assets, we'll give you dividends, we'll siphon interest, and we'll siphon off capital gains, and you'll be great. Well, how did that work for someone in 2008 and 2009? They saw their value devastated by up to 50% or more. Clients are also no longer accepting that old adage that if we hit a down market, just hang on because it'll quickly come back. But when you see it go down half the way, if you're out of the market, then you know, yeah, you've lost some because when you didn't get out at the top, but at the same time, you're not there at the bottom, and you can then hopefully buy when you start to see it going back up. So Wall Street's buy and hold just does not work well, and our clients don't want to ever be exposed to the risks they were exposed to in 2008. And here's a way to take a portion of their money and be able to use that for premium dollars for protection for their family and potential growth of cash value for future needs. You know, the flexibility features, providing a plan for being able to access future accumulation value via policy loans for an active retirement lifestyle is a great way to show other benefits than the death benefit that this policy can do. You can still accumulate more interest because you've got higher caps than you do in annuities. Baby boomers are getting older. They're looking for security. They're looking for potential supplemental retirement income. And this is a way to help them reach their potential to be able to provide for them the assets they're going to need in retirement, the cash flow they're going to need in retirement. Now, the death benefit's going to protect their family. They're going to have the ability for possible higher accumulation value if markets respond, no risk of loss of net premiums due to a decline in the index, minimum guaranteed interest rates. They avoid probate, avoid the potential to avoid estate tax there. So serves many functions, the product. You know, you could talk to your client and say, if I can show you how to protect your family and potentially supplement your retirement income, would that be of interest to you? If I can supplement your retirement income and place the assets outside your estate for probate purposes, would you be interested in that? With Indexed Universal Life Insurance, you know, the client's got to fill out an app, take medicals, pick index strategies versus how much to put in the fixed account, caps, participation rates, specified rates. These are all new to many clients. Segment terms, all the riders. It can become very complex for a client with that much information. It just becomes information overload, which so often results in no action being taken. So what we've got to do is break down the information into bite-sized choices for the client so that they can understand, here's what this will do for you on a death benefit basis. Here's what this will do for you on a cash value accumulation basis, and break that down into smaller pieces so that you can explain to them, here's how each of these works, here's how the fixed account works, the various strategies work, and so you can advise your client on what is best for their specific situation. Because we sell risk reduction. We sell discounted dollars for a death benefit. You can create an estate for your family if you consumed it all. We sell future potential supplemental income, accumulation value buildup. For somebody who wants to reduce their risk yet obtain a superior yield, we're really the best game in town. They're not getting these yields out there. For someone who wants less risk and more certainty, the IUL's upside potential and downside protection can't be beat, because we're going to protect your downside. We're still going to offer you significant upside, and this is really great for almost any client that you're going to come into contact with, unless they're in their 70s or something like that, or 80s. For the high net worth client, appeal to their knowledge of the product, their knowledge of the markets, their knowledge of how indexes work, and then tell them they're not going to have any risk of a loss from an index. Now, for individuals in their 30s with a good job, appeal to what the protection can do for their spouse and young children, and then bring in what it could do for them for their supplementing their retirement income. For the individual in their 50s, appeal to their need to protect family members while helping them supplement retirement with higher potential accumulation value. All of these go into making this a product that someone will like, because we provide the safety of a 0% floor, the possibility of higher interest earnings. American National is going to absorb the investment risk, so now they've transferred the risk of investment to American National. We're taking that on. They can sleep at night. A death benefit, which completes retirement plans for a spouse, takes care of family members, the ability to realize retirement income from the policy if needed as the policy grows over the years, ability to get loans once that value is established, and do so on a tax-deferred basis. Signature Indexed Universal Life, 100% participation on all the strategies. Minimum of 3% on caps is contractually guaranteed. They'll never go below 3%. 3 annual point-to-point indexing strategies, so someone can spread out their premium dollars and use different strategies to accomplish different things. Fixed and variable policy loans, 3 death benefit options. This product is easy to understand, and yet it has the diversification we all look for our clients. It has higher target premiums, high caps, 100% participation rates. It's a great 20-year cash value build-up accumulation, a larger income stream than the old Anico IUL, rolling targets for 2 years. It's just a superior product, and that's why we brought this out to you in the field, because we want to do the best for your clients. We think this product will do it. We hope you'll take a look at it. We'll hope you'll give us some time with it, talk to our call center about it and the like, because we're excited about this. We think this is a great new product. We thank you for taking the time to join us today and to listen. You have a great day.